Good morning, trading world. It is March 23rd, 2022, and this is my pre-market outlook and technical analysis for day trading the SPY. The title for today's outlook: Bonds in free fall and how this could topple the market. Right now, bonds are in free fall, close to hitting levels we haven't seen since May of 2019. Let's take a brief look to why this is important. Understanding bonds and their effect on the market is a hard thing to wrap your mind around. Bond yields shooting too high can have an adverse effect on markets, and so can bond yields falling too low. So what gives? Bonds have a direct connection to the two biggest sectors of the S&P 500, the financial sector and the tech sector. Bonds and the financials. Bonds have an inverse relationship with interest rates. The higher bond yields, the lower the interest rates usually, and vice versa. We should all understand that banks and most financial companies are more profitable when interest rates are higher because the yield spread premium they can charge is greater during times of higher rates. Now on the other side, the better bond yields are, the cheaper it is to borrow money. So companies that don't have a profitable product can borrow their way into looking good. And companies that do have a profitable product can afford to use borrowed funds to buy back their own stock, which in turn falsifies PE ratios. Right now, we have a lot of companies that have these super high valuations based on the fact that money is basically free to borrow. As rates continue to rise and bonds continue to fall, it is going to force a lot of company valuations to fall, having to incorporate paying for borrowed funds again, and not being able to borrow as easy as before. How does this affect the current market we're in? Think about this. 80% of the tech sector are hooked on this new lifestyle of borrowing for profit. The tech sector is the largest sector by market cap in the S&P 500. And simply put, if the tech sector falls, it could drag the entire market down with it. Bonds falling below 145 is that Maginot line for me. So that's basically what is going on in a nutshell and why I'm paying so much attention to bonds right now. Bonds and interest rates. With that being said, let's get to the key levels of the day. Alright, here we have the key levels of the day, starting on the resistance side. We have Jack resistance area at 448 to 449, Queen resistance area at 450 to 451, and King resistance area at 452 up to 454. On the support side, we have Jack support at 447 to 446. We have Queen support area at 445 to 444. And King support area at 443 to 435. Looking at things today as far as the bias, the main thesis of the day is bearish closing. Give me just a second. The main thesis is bearish, closing below 449.59 with a projected low or target of 446 all the way down to 442. Now, the alternate thesis is bullish, closing above 449.59 with a projected high or target of 450 all the way up to 454. The time frame in control now is the weekly, and this is happening as the daily inches closer to overbought territory. The current channel we are in is 425 to 453, with the minor channel being 443 to 453. Let's get into the scenarios for the day. All right, our first scenario is a range day structure. We could look to set a decision area upper boundary around the jack or queen resistance area before chopping lower, then chopping higher, and then again lower at some point. So this is probably the most probable scenario. Is a range day. Keep in mind, range days, the path of a range day, it's almost impossible to pick. But this is just how I see a range day playing out. Going into scenario number 2. All right, here we have scenario number 2, which is our rounded reversal day type structure. We could get a continued, I started with the vice versa version, which is the continued push higher, finding our midday chop around our queen or king resistance area, and then the second half of the day coming down with the same amount of force that we went up with during the morning. Now, the vice versa scenario of what we could also be looking for on the rounded reversal day is going to be something like this, where we come down to either our queen or king support level, and then the second half of the day going up with the same amount of force that we pretty much came down with. That's our rounded reversal day type structure. The thing to notice today, the probabilities for the rounded reversal day type structure and our next scenario, which is trend down, are pretty much the same. Let me bring that up. All right, here's our last scenario, which is our trend day down. We open with a gap down, and we start with a slight rally back toward the previous close. And actually, as far as we're down, it's not going to be a slight rally. It's going to start off seeming like a full-on rally, headed back toward the previous close, represented by the blue line. And at some point on or before the previous close, we're going to find resistance, reverse, and that's going to get us into the main trend of the day, which would be down, taking us to our midday chop area, which is going to be either the queen or king support area. Going into the second half of the day, most times we usually have a head fake to continue the strong morning trend, but then it turns out to be a head fake, and we'll usually get some type of rally back into the close. So those are the scenarios that I'll be preparing for today. We're kind of in this range or area where volatility is dropping, and we're just going to kind of hang out and explore the top parts of this range until the daily chart is back completely in overbought territory, and we're going to see what happens to the weekly. At this point, I don't think the weekly gets completely back into overbought territory. I think we get a head fake on the weekly. It may drop the baton, so to speak, and we end up going back down. Because the other thing that I'm looking at, the monthly is now starting to be in play. And it may not be long here, maybe April, May, before the monthly chart has control. So those are the things to look out for. Things are kind of slowing down. I've mentioned about, or I do these analogies where the market is a runner. Well, imagine VIX being a measure of endurance and how far you can run. And right now, the market has gotten lazy. It's not getting up and running every day. So that endurance is shrinking and it's coming down. But it's nowhere near where we first started. It won't take as long to be running a marathon, running a full marathon like it did the first time. There's not going to be the need to warm up and take, months on end to warm up and get back into shape. It won't take very long at all this time. So keep that in mind. Make sure you understand your risk of each position that you take, and that you stay in practice of knowing and understanding that risk and how to manage that risk. I hope this helps. And as always, wishing you a positive trading day. Have a great one.